Welcome back to Ask an Advisor. I'm Krista DiBiase here with Wes Moss.
Hey, Krista DiBiase.
Ask an Advisor is where we go deeper on all things investing. We here at Team Clark hope to serve you in every way we can with Clark Monday, Wednesday, Friday, and Wes with us on Tuesdays. And if you have a question for Clark or Wes, you can go to clark.com/ask.
And people have questions, and they're getting more and more complex. They're getting tougher.
Feels like we're kind of on a roller coaster right now with the stock market and everything. And today you're going to talk about a couple of things that are affecting us a lot, that and then inflation, right?
Inflation. Sounds like we need to talk about inflation. I don't think we've done a segment around that. It's always around us, and it's scary, but it's necessary. So we'll talk about that too.
Okay.
But maybe we just start with the market. And
Yeah.
I was watching, I didn't watch this whole movie, but for some reason it was on, I don't know if it was Netflix or one of the many subscription video on demand apps on our television. And the movie was Brother, Where Art Thou? Have you ever seen it?
I have not seen that one.
I'm not going to say it's George Clooney's finest role, but he's kind of the main guy in it. And there's this kind of hapless group he's part of this kind of hapless group of guys going around, and I don't remember exactly what they're trying to do, but they come across, they're walking on this riverbank, and I think I remember this because of the song. It's so powerful in this, and I think I had the Brother, Where Art Thou soundtrack. And this goes back to the song of safety that comes from sirens, as in this alluring song that might lead you astray. Just like in the movie Brother, Where Art Thou? These guys are walking down the riverbank, and there's these three women kind of rise out of the water, and they sing this magically seductive, alluring song. It's like, wait a minute, oh, wow. And the actual singers, they're not in the movie, but it's Alison Krauss, and who's a phenomenal singer, and I think Gillian Welch and Emmylou Harris. So they're like the most beautiful country voices of all time. And this song, and they are sirens. And what happens is these three, call them hapless guys that are on this adventure, ending up down by the riverbank. They end up getting passed out. They wake up dazed and confused. One of their buddies is missing.
Oh,
I think it's Pete. He's gone. And they listen to the song of the sirens, which is it seems like a good idea, but you end up in a bad spot. And I think that's what happens when we go through market turmoil. And there's been a lot of market turmoil in 2025. I mean, you cannot go more than 5 minutes if you're watching the news, which I don't always recommend always watching the news. You're going to have heard about tariffs and tariffs and tariffs, and the stock market's been reacting like a roller coaster. And there's been some real fear created in 2025. We've had a couple really placid years in the stock market, some really strong gains, not a lot of big pullbacks. But 2025, we've seen that. So what happens is that when we go into these tougher times and they get a little scared, and we're worried about the economy, and we're worried about the stock market, that siren song of come to safety really starts to be louder and louder. And that song of safety is, hey, just sit this thing out and go into, just wait this whole thing out in cash. And we don't necessarily, as investors, we don't always think of it as, well, maybe I'll have some cash. It's really, we naturally go to, I just want to protect everything. I want to just make everything safe because this whole safety thing sounds really good right now. And it's just the human emotion that drives us. And that's why we've seen, and there's been multiple reports throughout the year, and I'm sure this is only going to be exacerbated as the tariff worries kind of accelerate. More and more people are taking money out of just regular balance. Yes, they're taking money out of stocks and putting them to money markets or cash. They're also taking out balanced accounts. So target date funds we've seen money pulled out of even a balanced account and just go to cash. And that feels okay for the really short run. But what happens is when we listen to that song, and it says, well, A, the world is scary, go to cash. B, hey, this time is different, is another real theme in that song. And that is what makes every correction its own unique characteristically scary, is that the sirens are saying, go to safety. And they're also saying, because this time it's different. And this time it's worse than ever. And this thing is going to be harder to come back from. And we just naturally extrapolate to, wait a minute, maybe they're right. Maybe they're right. So maybe it would feel good to go to cash, and it does feel good to go to cash. The problem is that the markets inevitably recover, or they at least have in the past. There's no guarantee of that, but the American economy figures a way out to kind of move forward, and then markets recover. In fact, a lot of the best days in the market we see, the biggest gains, usually come right around the biggest losses. So it's fear, wait a minute, it's not that bad. And sitting anything out ends up really having our money stagnant, and then we don't build wealth. So, and here's how I think we avoid those sirens and avoid that allure to just go to cash and keep everything in safety. One, and hopefully I think a lot of our listeners probably have the following. One, if you have some sort of plan, remember your financial plan is not predicated on the market steadily and perfectly going up every year. It's just not. It's part of financial planning is the understanding that markets do go up and down, and there is volatility. So if you have a plan, I think it helps you avoid the riverbank here and avoid the song of the sirens. Number two, if you're already diversified, because if you're listening to this show, you're probably not like a hedge fund that went all in on one specific sector. Didn't get all in on a few stocks that were doing really well, only to have that unravel so quickly that you see really big losses. So that just simple diversification really goes a long way to helping you avoid that alluring song that ends up putting you into cash, missing out on markets. And then three, I think it's always a good reminder, corrections are really normal. They are a fundamental part of the market. Without them, you wouldn't have the average 9, 10, 11% rate of return we've seen. There's really no asset that's just a nice, easy guarantee walk in the park to have that big a rate of return. So along with these great returns we see over time, naturally comes some volatility and a little bit of pain. Otherwise, everyone would participate. So this time, even though the situation every time is different and the market goes down for a new reason, it's not different fundamentally because markets do eventually recover. So the siren's job is to shake you out of the market, scare you. And we just have to remember the long term of the market. If you go back to the early part of the year 2000, right after .com, the S&P 500 was at 1,400. Here we are today around 5,500. That's an incredible, more than double, more than tripling of the market over that period of time with lots of ups and downs. So we have to remember that, and we have to stay patient and participate, and that's how we build wealth. And we've got to be able to cover our ears to not listen to that song of safety that's sung by the sirens, because they're there to make sure you don't grow your wealth over time.
All right. Well, we have some questions, and of course, you're going to have some related ones with everything going on. This came in from Kathryn in North Carolina. Hi, Wes. I'm really enjoying Ask Wes Moss. I'm 55 and my husband is 56. I would like to retire this year, but with the recent market downturn, my husband is reluctant to stop working. We're 100% in equities and stock. We should have shifted to a less aggressive portfolio sooner. We had about $2 million in retirement assets earlier this year. We were advised to start shifting about 20% to cash money market. Right now, we only have $41K in cash. My husband can't bring himself to sell stocks at a loss to convert to cash. Therefore, he thinks he needs to keep working and wait for the market to recover. Next, I have a pension that I'm eligible to draw on this year with different options. $1,600 per month for life, or $3,000 until age 62, then it decreases to $800, or $3,000 until age 65, then it decreases to $250. My pension is not adjusted for inflation. An advisor said we're okay to retire and we could withdraw more than 4% using guardrails. Our living expenses are around $60,000 to $70,000 a year. We would like to spend more time traveling, home improvements, etc. I plan on working part-time, which will bring in about $25,000 to $30,000 a year. I would love to hear your opinion.
Whoa, Kathryn in North Carolina. There's a lot there. And A couple of things. So right out of the gate, it makes me think, as I'm kind of taking some notes here as you're reading this through, Krista. Kathryn's 55. So you guys are young. Mm-hmm. You're really young. And it sounds like you've getting to that 2 million number when you're doing some planning. That number works for you guys. And remember, if that works for you, just like we were saying earlier, financial plans are not predicated on a perfect straight line as these assets going up. So a financial plan knows that you're going to have these big dips. The only catch to that, and this is, I think, what you were trying to accomplish by having some balance, is that you don't want to go into retirement 100% in equities. Mm-hmm. For this exact reason, because then you almost get beholden. You become kind of a prisoner of how well the market does. I mean, you're trying to plan your life and the next 30 years, 40 years. The market could care less about your plans. So the market says, oh, wow, we're down 20% or 50. Your assets are down from what, 2 million down to 1.8. Mm-hmm. They could go to 1.7, 1.6, depending on how big of a correction we have. And then now, all of a sudden, you're totally beholden to that. And the market just says, oh, sorry, you were supposed to retire, and now those numbers just don't work anymore. That's why it takes you really do need that balance going in. And that's why having 30 or 40% or even 50%. Now, I think you're pretty young to have 50% in safety assets. But even having a couple years worth of dry powder and thinking about your spending need of $70,000, you're going to be making 25, so you really only have a need of $50,000. 3 years of dry powder is $150,000. So on $2 million, that's only a 7 or 8% weighting towards that. So it's almost so as you started to get some balance, this market didn't cooperate. I would lean towards the following. Your husband, I think his instinct is similar to what my instinct would be, which is, hey, we planned on having about 2 million, and it's not just the number, but also a diversified 2 million, where or at least some significant portion of it is in safety. So if I were Kathryn, I would probably say, hey, let's just postpone this. Let's keep working, keep saving, and allow the market to recover. You don't want to go right into retirement in the middle of kind of economic turmoil if you haven't already had balance. Balance would have solved for this, but you got caught a little quickly here or just a little bit too late. So I like the idea of just working a little while. It gives time for the market to recover, save a little bit more, and then I think you're in good shape. If I think about the bigger picture spending numbers, and I did some math here on the low, you get this low pension amount that goes forever, something like $1,650 for the rest of your life. And then you have these tricky options of $3,000 or $3,500 until 62, and then the number goes down, or till 65 and the number goes way down. Really depends on how long you live. If you think about it, if you're only planning for the next 10 years, just take the highest number that lasts for 7 to 10 years. But if you're going to live till 90 and you're trying to have some longer term protection, that lower number times, call it 30 or 35 years to get to 90, that of the options that you cited has the largest amount of cash that's given to you, even if you adjust it for inflation. So it's got the highest net present value as well. I think that's the choice you have to make. If you think you're going to be living into your mid 80s or 90s, I wouldn't discount that option one, which was the lower amount, but it lasts forever. The last piece of the equation here, from what I can tell, even if I inflate your spending to 80, and you're going to have Social Security in call it 10 years or so, of call it 50 between you and your husband, that covers most of the spending. And the gap is only $30,000. Let's call it $40,000. Well, even if your portfolio only gets back to $2 million, $40,000 on $2 million per year, it's a super low withdrawal rate. It's like a 2% withdrawal rate. So I think, and that's probably why you guys are thinking about retiring so early already, is that your withdrawal need, if you really start doing the math, it's pretty low on a percentage basis. And that's an awesome place to be when you head into retirement. So I think you're really close anyway. If it were me, I would. You hadn't quite finished your retirement and investment planning because you really want a diversified portfolio by the time you start having to pull a little bit from it. So maybe work a little longer. I think your withdrawal rate's in a super safe place. And I can't answer all the questions perfectly here, but I think that gives you, at least I think I'm giving you my opinion on most of these. Don't discount that lower option that lasts for life.
And I would just add in a little something. If you do keep working, your husband keeps working, don't put off the home improvements and travel. I mean, while you have the higher income, maybe now is the time to do some of those things, because
100%.
people put off travel and things like that until they're older. And sometimes it becomes harder when we get older too. So
the last thing you want to do, and I've actually done research on this, Krista, where the home improvements and renovate. Here's one retirement. I would say this is like more than a pothole. This is like one of those jungle traps that you're running along and you fall through, and there's a bunch of bamboo spikes here. It's called a renovation.
Oh yeah,
in retirement. That is the worst possible thing you can do after you've stopped working. If you're going to do housework and it's going to be kitchen and bath, which you think you have a budget, it never works out exactly that way. It can bleed higher and more expensive. So happy retirees, one of the things that they know to do is take care of the bigger costs while you're still working.
All right. We'll go to another question from Roger in Connecticut. Hi, Wes. I often hear advisors, in my opinion, overly pushing Roth and Roth conversions. Don't get me wrong, I'm all for Roths. We've personally done Roth conversions, but I cringe when I hear advisors talking about converting over time everything to Roth. I think it's better to have a balance of Roth and tax-deferred accounts. If you converted everything, you would be at least throwing away the standard deduction and low first brackets. Also, to qualify for ACA insurance, you need some income, or you would need to go on Medicaid. With a balance of Roth and tax-deferred money, you can choose your tax bracket and have a lot of flexibility. Beyond my own finances, should we be lucky enough to have excess money, I can QCD some qualified money into charity of my choice, avoiding tax completely. In my opinion, Roth and Roth conversions are awesome, but you should never convert at all. Am I wrong? And if so, how am I wrong?
Roger, you're becoming like a Jedi Knight when it comes to managing your tax bracket. And I love hearing that. I think part of it is just to get heard sometimes in financial media, Roger, you got to take a really strong position. You know, there's people that I've interviewed on my show that write books about Roth conversions, and they write an entire book about why it's the only option you should ever consider. And the real world it's really rarely ever like that. Sure, having money in a Roth, of course we know, is great because it's tax-free money, grows tax-free, comes out tax-free. But there's a really high cost to put money into a Roth. And you are throwing away some things. You brought up a couple good points. If you have zero income, then you're right. You first of all, you don't need income to pay for a supplemental plan or a healthcare plan. You can be on ACA, healthcare. As long as you can pay for it, you can be on it. But if you have zero income, and that's hard to do too, because you're going to at some point have Social Security. If you have zero income, then you do run the risk of ending up looking at Medicaid. So I think that being able to control your income, having a regular IRA can help with that. Now, I don't think you need to manufacture your income, because there's going to be enough in retirement with Social that you're not going to have zero income. The second part is that the two things that really stand out is, look, when you're managing your tax bracket, the standard deduction does work. Now, this is going to be different for everybody. Consult your CPA for your particular situation. I'm not a CPA, but I'm always looking at my tax brackets. And I have definitely known families that I've worked with that, let's say somebody was in a student year or have very little income. They were way away from Social Security. The standard deduction helped them do a Roth conversion. So you're right, in a big sense, that standard deduction kind of gets wasted if you have zero income, and you can utilize that if you keep your tax brackets really low to even do future Roth conversions, because you can utilize that. The other piece here is, if you're charitably minded, the QCD, the qualified charitable deduction that you can start at 70.5 from your regular IRA, that goes away if there's no IRA money. So you don't want to imagine the amount of money you're saving by doing a charitable gift from your IRA, because you don't pay taxes on that. Everything's in a Roth. You've kind of guaranteed that you're going to pay taxes on the money to get it into the Roth, and then you're giving the money away. So just for that reason alone, you may want to keep some regular IRA money if you're charitably inclined and you're going to give away dollars after age 70 and a half. So look, short answer, you're not wrong at all. Roth is great, but the balance here absolutely can work for you long term.
All right. And when we get back, you're going to help us understand inflation, which has been frustrating so many people.
So frustrating. Can't wait to talk about inflation. Welcome back to Ask an Advisor. Wes Moss, along with the Krista DiBiase. It's so much fun to be here with you. You're such a pro when it comes to all this stuff.
Oh my gosh. No, I am not.
I feel like you should just answer the questions.
Absolutely
not. You really could. You could probably answer a lot of these.
I don't think so, but I do learn something for sure every week. And I've gotten some great feedback from other people who are absolutely enjoying the more in-depth way that you get into investing as an advisor yourself. So,
well, we're going to get into a controversial topic, and it's called inflation. And we all know about it. We all think about it. I just remember the last couple of years, I do a radio show in Atlanta called Money Matters, and at some point I think we started calling it Inflation Matters because it was the only topic: inflation. And so I want to talk here for a minute about how to beat inflation, how to think about inflation, and how to protect yourself from inflation when it comes to retirement. So first of all, we had this long stretch where we didn't really worry about inflation. We had about a 10, 11-year stretch after the great financial crisis where we had really low inflation because we had not a great economy. Mm-hmm. But it lasted for a really long time. You can call it globalization or whatever. There's a lot of reasons for it. And we almost forgot that inflation was a problem. And it was so mild. I think even in 2009, we actually had a 1 year of deflation. Prices went down about 0.5% for just that 1 year. And then we had a bunch of years where it was 1 and a third, 1 and a quarter. I think this also manifested when it came to Social Security. We had big inflation back in 2022 and 23, and people got big raises for Social Security. And it was because we had big inflation. And people had forgotten that their Social Security was even tied to inflation because you didn't even notice a 1.1% bump in your Social Security check, right? It was we just got lulled to sleep for almost a decade that there was almost no inflation. It was actually below what the Federal Reserve even wants. Which brings me to the point that inflation is absolutely necessary. It's almost like an ingredient. It's like salt, right? If you have a little bit of salt in a biscuit makes for a great biscuit. A little bit of salt in a stew makes for an amazing stew. Without it, remember, we used to have wars over salt. It's a big deal. Mm-hmm. But the minute you dump salt into a stew or into a biscuit, it ruins everything. So it's very much it's an ingredient we want to manage, and that's exactly what the Federal Reserve does. They don't have a target of 0 inflation. They have a target of 2% inflation. Because if you have steadily rising prices, but in a manageable way, their mandate is actually, the way they say it is price stability, but it's price stability at 2% every year. And it kind of has this gentle nudge for all of us to go out and spend because we know that things are going up in price. We're not rushing to the store to get avocados because we think they're going to go up by 2% over the course of the year. But we have this general sense of things get a little bit more expensive. So it's very healthy for the economy to have this pinch of inflation. Now, as another example, and I'm not going to say this is a good thing, but we see, if you go back to the beginning of 2025, the tariff worries of, hey, wait a minute, I think prices are going to jump a lot for XYZ car. We saw we saw sales for cars go through the roof because people are trying to get ahead of the inflation. Just as an example, it motivates us to go spend today. So it's a really good thing to have. We just don't want a salt block in our stew. It kind of ruins everything. So we need it. But it's also back in the vernacular in America. Investors who didn't talk about it for a really long time and forgot about it. the reality here is that even at a 2.25%, 2.5% inflation rate, it wilts the purchasing power by 20, 30, 40%, depending on how long your retirement is. And I think of it through, go back to a car example. If you only had dollars for specific items, imagine if you only had a wallet for food, and you had food dollars, and you had gasoline dollars, and you had car dollars, and if you let's go back to 2000, and I don't know the exact date here, but I think let's go back to, I don't have my glasses here, Krista, not see. I keep going up in my readers. If I go back to 2020, and I think about where inflation was for cars, and again, we had a decade of car prices not going up. It actually went down a little bit. If I had $30,000 in my car wallet, and I was eyeing, let's say, a entry-level Lexus, that's a happy retiree car, so I use that. If I waited for 2 years, imagine we're talking about dollars in your wallet. They're not invested in anything. They're it's in your car wallet. Now, 2 years later, because of all the supply chain disruptions and the pandemic, now that same car went from 30 to 40. But your wallet still only has 30 grand in it. So your car dollars, they didn't change, but they became way less affected. They essentially wilted by 25%. And that happened. Now that was a rapid example. We had big inflation in just a 2-year period. But it happens to almost every category, and it happens pervasively over time. So I want us to remember that it's a part of the equation. It's not as though we didn't have inflation, now we had inflation, we're going to go back to no inflation. That's not the case. It's always there. It's part of the Fed's mandate. So what do? We've got the very simple answer here is you have to invest your assets in areas that inflate along with inflation. Your main quarterback for this, probably the best historical example of something has given us a rate of return above the rate of inflation. So remember, if stocks are up 10%, inflation's up 3%, your real rate of return is only 7%. So the main quarterback in being able to fight and get a rate of return above inflation has been historically broadly diversified equities. I think of it in terms of categories to see how that works. Like, why do stocks protect us from inflation? Think about these sectors like healthcare. Think about sectors of utilities. As their cost goes up, they pass it on to you, and we just have to keep paying more as consumers. That goes back into earnings. Companies now have more money because they've passed on the price to us. Well, we can now be the beneficial owner of that company that continues to have more earnings because they're inflating their prices along with inflation. Potato chip company, if you're making potato chips, potatoes become 10% more expensive, and now your end chip costs 10% more, what do? That little yellow bag of potato chips is just 10% higher. And as long as if you don't own the potato chip company, then you've now been hit from inflation with no sort of recourse. So we've got to own the potato chip company, if that makes sense. And we've got to own a broadly diversified basket of companies that are able to inflate their prices along with inflation. And we've got to be the owner of those companies to benefit from that. And that's how we protect. So stocks are your main quarterback. I would put real estate into that same category. That's been very effective to hedge against inflation. And I think about, there's a recent billionaire list. I don't know if you've seen this.
No.
Bruce Springsteen is on the list.
Oh, okay. The boss.
The boss is on the list. He's a billionaire.
Wow.
Arnold Schwarzenegger
is
on the list. How did he get to be a billionaire? Do you think his royalties from those hit movies like
Terminators?
You think that
Terminators franchise?
90s.
Yeah.
You think that really got him there?
No.
Supposedly. Back when he was Mr. Universe, he got a little bit of Mr. Universe money. What did he do with it? He bought California real estate way back in the 70s. So the path to being a billionaire is not saving. It's about investing. And I don't know the exact properties he bought, but I think he bought a lot of it, and it's worth a ton of money today. And that inflated along with inflation for that 40-year period. So real estate does that. And then I would say more of your defensive line. This is not high-powered offense, but owning bonds at least can keep you pace with inflation and maybe a little bit of a real rate of return. So if inflation is 3 and bonds are paying you 4.5, you're not only keeping up with inflation, but you have a little bit of a real rate of return above that. So collectively, you've got your quarterback that's stocks and real estate. You've got your defensive line, call that fixed income or bonds. And collectively, that grouping should keep us ahead of inflation because we own assets that inflate along with inflation. And it's not going away.
Okay, well, let's go to questions. Cal in Georgia wrote in with this one. I'm 28, married with 2 kids, and my wife and I max out our Roth IRAs and contribute 15% of our income to 401ks. My parents recently retired early, but my siblings and I are concerned that they didn't account enough for inflation and may run out of money in their 70s or 80s. We want to set up a long-term family savings or brokerage account that we can all contribute to over the next 15 to 20 years. This would create a safety net in case they need financial help later, which could also be when my kids are starting college. What's the best way to structure something like this? Should we use a joint investment account, trust, or something else? Any advice on the managing contributions, investments, and tax implications would be greatly appreciated. I just have to say, wow, most people would not think of doing this for their parents and have the foresight to realize this could be a huge problem.
It's pretty cool. It's interesting though. Cal's 28. You're now making some good money. You're maxing out some of your retirement plans, and you're thinking about your folks who sounds like they retired early but without a lot of money. So I don't understand that one. But I'm all for retiring sooner. But if we don't have the money to do it, then it really is going to be the burden would be on the kids to help. And which is cool that he's able to do that, and he's got siblings too. So you've got multiple people that are able to contribute to this. So naturally, he's thinking, okay, well, let's open up an account. Let's all put money in, and it'll grow over time. And it's a safety net. And I'm just going to assume. I don't think Cal said how many siblings he had, but I'm going to assume I'm from a family of 4. I'll assume he has 2 siblings. So you got 3 people to try to help with the safety net. And Cal has 2 kids. And the way I think about this is that in 10 years, Cal's kids are going to be in middle school or high school, middle school. And then Cal's sister's going to have kids that are middle school and high school. And then his brother's going to have kids in middle school and high school. And one of them is going to say, I want my kids to go to private school, so I don't have enough money right now to contribute to the joint account for mom and dad. And then one of the siblings is going to say, well, I'm not sending my kids to private school. My kids go to public school, so I have more money. So that's your choice, so you still have to contribute. And wait a minute, we get this joint tax return, and it's now 3 people have to sign it, and somebody just got a bunch of interest. And wait a minute, I didn't realize it was so tax expensive because we all are on this joint account, and so-and-so stopped contributing. So those gains are my gains and I've done more. See where I'm going here, Cal?
Yikes.
Absolute nightmare. Absolute nightmare. If you collectively with your siblings start a joint account, which sounds awesome and noble, but it's also a recipe for absolute sibling disaster. And so how do you do it right? And again, it's as though I've been speaking from experience from this. I've seen this happen a lot.
I bet you have.
Because what is a guarantee is that everyone's life will change financially, and everyone's financial priorities change, and everyone's different kids. But the priority to take care of the parents still remains. The question is who is most responsible? How do you keep it fair? How do you keep it equitable? A couple ways to do it. One, in my opinion, you never would want to do a joint account. It gets complicated and then imbalanced, and people owe taxes and people stop contributing. So the way to do this would be to open up a family trust where you write the rules to begin with. So you set up some sort of guideline that is, hey, we're just going to start this year. We all agree that we're going to each put in $10,000 or whatever it is, $50,000 each. And then we're just going to let that grow. And here are the rules of the trust. The money goes to our parents. And an estate planning attorney can do that for you. And it's less about, well, it's about laying out the guidelines today so that you don't have these sibling rivalries down the line and these family issues that will inevitably come up because we're talking about money and priorities. And everyone's always are going to eventually be different, even if they're almost exactly the same today. So that is one way to do this, is to kind of pre-script the rules. And that way, I think will really help long-term not have any sort of family divide. The second way, and more practically, the way I could see doing this, and this isn't necessarily perfectly fair either, because let's say you're making a ton of money and you're paying 40% in taxes, and your sibling is making good money but paying 20% in taxes. It takes you more earnings to end up with $1,000 at the end of the day to give to mom and dad, but we're also trying to help mom and dad here. So I think that it may be a more practical way to think about this, and I've seen this work, is that everybody at some point when they need the money, which also should give you a long time here, 10, 20 years before they start running out, it allows you to save money and increase your earnings over time. Then you start supplementing the parents once a month. Everyone says, oh, we'll all chip in $1,000 a month, and that helps fill the gap between what mom and dad are getting and what they really need. And that's kind of an easier, more palatable way, I think. May not be perfectly fair because everyone's tax rates are a little different. But this is a charitable endeavor here. It's a charitable act. So I would look at it as, if you're going to do it now, you're going to want to look at some sort of trust formation, and you're going to have to talk to a estate planning attorney to do that. Otherwise, think of it more practically down the road. Everybody contributes a little bit over the course of time.
I would also see.
Yeah, what would you say on that?
I mean, I would just, one other thing, I would pay for them if you can find a fiduciary who's willing to do an hourly sit down with the parents. They may need a reality dose of what they're going to need to save and spend in order to maintain their money over time, and look at their Social Security and the whole picture. And then maybe they can get on the kind of budget that would enable them to sustain themselves. Like, I don't know if they've done something like that, but I would definitely recommend that as well.
I think that's that's a really good point. It's that there's got to be some transparency. Mm-hmm. When you've got a bunch of siblings and mom and dad retired early, why did they retire early? Maybe they have plenty of money coming in. Maybe they have 10 grand a month coming in, but mom and dad are, twirling the world and they need 20 grand a month. Mm-hmm. Now, are all the siblings going to be willing to kick in for that? So it always goes back to kind of these priorities. If it's really, look, hey, mom and dad just don't have enough money, and then they've got to be able to just live, and then it's a different conversation. So to your point, Chris, the transparency with the family is so important. And I think you're right. If you sat down with a CFP or a fiduciary, they can really get you some clarity around their financial situation, which will give you clarity around how you really can help.
Mm-hmm. Okay, Ryan in Wisconsin wrote in with this one. Are there any advantages to dollar cost averaging more frequently? I currently buy index funds once per month. The market can change drastically over a month, so I'm wondering if weekly or even daily buys would be a better way to smooth the ride while still being an average meet-the-market investor.
Okay, Ryan.
Mm-hmm.
There's no way to know this because you don't know how the market is going to ever react into the future, right? So if you were to say, I want to really dollar cost average, and you were starting in 2007, then slower dollar cost averaging would have been better because the market went down for 2 straight years. If you were deciding to dollar cost average in early 2020 when the pandemic bottom came, then dollar cost averaging would have cost you money. So forget more frequently. You want to do this all in one lump sum. We should really talk about this as a larger segment. But there is no perfect answer here because we don't know how markets are going to react. I think that what's most important, so there are plenty of studies around this, around 70% of the time. So it's 7 out of 10, but there's 3 out of 10 where this doesn't work. Putting money to work faster is better because markets do have the propensity that they're up over time, right? So the quicker you get money invested, the higher the probability, and no guarantee here, that your money has a better rate of return. So to answer your question, I would say invest it when you have it, particularly when you're younger, and sooner is better. So I would say that would be my short answer to that really more complicated than it sounds question.
And we'll definitely do that in the future. I'll mark that down. Lisa in Texas says, Wes recently mentioned phasing into retirement. Aren't Social Security benefits driven by the beneficiary's annual earnings? Will reducing earnings or cutting those in half for the final years of a working history adversely impact annual benefits?
Not necessarily, Lisa. Remember, Social Security takes your top 35 years and then they average them. And you've got to remember, well, it really, this depends, but for a lot of folks, when you worked really early on, you've got some really low years in there. And even if you're scaling back to halftime and you're phasing into retirement, I call it the retirement gray zone, your 2025 earnings that are kind of working half are still probably replacing some of the really low years. So I think that, right, if we work from age 20 to age 65, I mean, that's 45 years. So we get a lot of years you can cancel out that don't even matter. We're only taking the top 35, and that's what your Social Security payments are predicated upon, and of course your age. So usually it does not hurt. It sounds like, wait a minute, I'm making less all at the end, and now it's going to reduce my Social Security. Usually the formula really doesn't have that big of a negative impact, because again, you can look at the best 35 years, and even part-time work may be replacing some of the smaller years way back when you were young working, super young working.
Okay. Well, thank you so much, Wes. Thanks, everyone, for tuning in today. We really appreciate it. We will be back tomorrow with a new Clark episode. Hope the rest of your day is fantastic.